smart future.
Collapse of one of the largest banks in the U.S. The recent collapse of Silicon Valley Bank, a specialized financial institution that had become one of the largest banks in the U.S. by asset size, has sparked fears of a financial crisis in the U.S. tech sector. The failure of the bank, which primarily served technology workers and venture capital-backed companies, was triggered by a run on the bank as depositors sought to withdraw their funds due to anxiety over the bank's situation. Despite its significant assets, SVB could not cope with the mass withdrawals, and its attempts to raise new capital failed. As a result, U.S. regulators seized the bank's assets and placed it under the management of the Federal Deposit Insurance Corporation. The collapse of Silicon Valley Bank represents the largest bank failure since the 2008 financial crisis and the second largest failure of a retail bank in the United States. The collapse of Silicon Valley Bank, which had extended over $4 billion in loans to wineries and vineyards since 1994, has caused concern for the wine industry. Wineries represented 2% of the bank's total loan business, but the impact is far-reaching, including difficulties in paying employees, bills, or credit card payments. The bank was known for its understanding of the wine industry and had amassed valuable data, which wineries used to make decisions on future sales, marketing, and farming. The founder of Silicon Valley Bank's wine division, Rob McMillan, who was renowned for his insights, has so far declined to comment on the situation. The loss of the annual report from Silicon Valley Bank will impact the ability of wineries to access comprehensive analysis for making business decisions. A run on Silicon Valley Bank has led to customers lining up outside First Republic Bank in Southern California to withdraw their funds. However, the bank issued a statement seeking to calm investors, stating its safety and stability. Both banks heavily rely on customer deposits, but the main difference is that Silicon Valley Bank's debt was in securities, while First Republic's was in loans. All this has caused a banking stock meltdown, with the US dollar, bond prices, and Bitcoin all crashing. Analysts are concerned that contagion fears could lead to a new financial crisis similar to the 2008 global financial crisis. Billionaire hedge fund manager Bill Ackman has compared the collapse of Silicon Valley Bank to that of Bear Stearns, the first lender to go under in 2008. U.S. banks such as First Republic Bank, Signature Bank, Charles Schwab, U.S. Bancorp, Wells Fargo, and Bank of America have all experienced significant losses. UK banks, including HSBC, Barclays, Standard Chartered, and Lloyds, have also been affected. Markets in London, Shanghai, Frankfurt, and Tokyo have all fallen, and analysts predict that Monday will be brutal. Observers did not expect a bank run to occur, and the problem did not come from where it was expected, highlighting the unpredictability of finance. Despite this, analysts are reassuring about the risk of a capital or liquidity incident among major banks, as banks have had to provide regulators with reinforced proof of solidity since the 2008 financial crisis. Morgan Stanley analysts suggest that the funding pressures facing SVB are unique, and other banks are not facing a liquidity crunch. Elon Musk has expressed his openness to the idea of buying Silicon Valley Bank after its collapse, but the response from at least one Tesla investor was frosty. Min-Lian Tan, CEO of Razer, suggested on Twitter that Twitter should buy SVB and become a digital bank, to which Musk responded, "I'm open to the idea." While one Twitter user supported Musk's idea, another criticized it, suggesting that Musk would have to sell more Tesla stock to fund such a purchase, depressing the share price. That's it for today. Like, share, subscribe, and comment.